Well, good morning, everyone. This is Mark Trice, ClearVista Financial. I hope that you all can hear us very clearly. I hope you're having a great beginning of the summer. Today is our June 2025 ClearVista Financial Perspectives Market Update. A lot of things have been going on, and we're excited to kind of share with you a little bit about those changes and so forth. We're always keeping a close eye on things, and this month a lot of activity, a lot of positive things that are going on. Still a lot of uncertainty, but we'll jump into that in just a little bit. Okay, so we'll talk about the index performance this last month. We'll visit about how that's going year to date. We'll talk about some implications in the economy as we talk about the macro economic update. How this impacts you, still dealing with a lot of tariffs and things. But you can always send us questions to our text line, 254-282-0495. That's 254-282-0495. Or send us questions or comments to info@clearvistafinancial.com. That's info@clearvistafinancial. If you want us to answer the question on the program today, send it to our text line, 254-282-0495. Okay, let's jump right in and talk about how the indexes did. Pretty good month. S&P 500 was up 6.5% in the month of May. The NASDAQ 100 up 9.56%. Don't get too excited about these things. I'll show you how they're doing year to date. Russell 2000, generally an indicator of the strength of the overall breadth of the market, up 5.24%. Long-term treasuries, well, they were down. Interest rates and yields, which we'll go into a little bit through that in a moment, but that is something that we'll cover in a moment. The yields are rising and stuff. The moderate index, which is kind of a moderate profile, if you will. If you're a modern investor, it was up 2% in May. I don't have it on the slide, but the New York Stock Exchange, those 30 of the largest companies in the country that are on the NYSE index were up about 3.4% in May. So let's take a little bit here, starting with this large cap index, which is the S&P 500 isn't just an index. You can't go buy this particular S&P 500. There are others out there, but remember, each candle represents a trading day, and usually we have anywhere from 21 to 22, sometimes 23 trading days during a month. You see, we have a lot more green this month than we do from previous months. Now, as I mentioned earlier, the S&P 500 index is up for the month of May. Year to date, the index through the end of May was up a whopping 0.5%. Okay, so we still are grinding our way back from that short-term bear market that we experienced in March and April. Now, we still are off with this index about 3.8% from that all-time high, which was in February of this year. So we still got some room to go just to get back to par, but we are seeing improved signs in the S&P 500. Let's talk about the NASDAQ. NASDAQ did really well in May. A lot of growth there, but we're still down year to date, down minus 1.82%. Minus 1.82% year to date, or we're down about 5.4% from the all-time high in December. So a lot of work still left to go. The Magnificent Seven, which has been kind of the bellwether for the last few years, is really no longer the Magnificent Seven. A lot of headwinds for those large tech companies that we were seeing involved in the growth the last few years of the indexes are really kind of lagging there still. All right, Russell small cap, Russell 2000, small cap index. It is up 5.24% in May, which is great. We're still down 7.25% year to date on the Russell 2000 index. Now, that was something we were tracking very closely. That's something that We would hope we would see more breadth in the recovery. But this recent sell-off, the Russell 2000 really did not do as well. And a lot of that probably has to do with um, small cap companies having higher borrowing costs. Interest rates are still high relative to where they've been the last decade, not relative to where they've been all time, but relative to where they've been the last decade. Money's more expensive, and small cap companies generally tend to borrow more than large cap companies. So that still, the Russell 2000 index is still off 15% since its 21 high. So we've not yet recovered back from the 2021 highs that we had post COVID. All right. Up next, the long term treasuries. We got more red on here than we do green this month. Long term treasuries were down 3.5% in May, like we mentioned. They're down minus 1.2% year to date. And what's interesting here is that we are still 50% below the 2020 high watermark, ending that 40-year bull market in bonds. And this is significant because a number of you, if you're working with other advisors and things, you're probably holding a very large percentage of your portfolio in long-term bonds. And this means that for the last 4 years, really, that part of the portfolio has been doing very poorly. And so it's important that you look at those things to make sure that you're not overexposed to long-term treasuries in your portfolio. You can always give us a call. That number is, again, is 254-282-0495, 254-282-0495. Moderate index did all right in May. We're actually up about 3% year to date, but we're still below that high watermark for the moderate index from November of 2021. It's hard to believe that it's taken us 5 years to get back to our high watermark on the moderate index. So we're still not there. All right, here's my disclosure. Always have to give the disclosure, take a moment to read it, memorize it. There will be a quiz at the end of the seminar today. So let's jump in and talk about some of the macroeconomic issues. All right. We are in a normal time of volatility. Moving into June, we see it uptick a little bit. And historically, you see the volatility increase in March and begin to decline in April. And that's exactly what we saw. June is a little bit of an uptick. I think this is relatively due to the phenomena. You may have heard the old adage of sell in May and go away. That's not an investment approach or philosophy, but a lot of professional traders tend to take several months off in the summer. And so you might see volatility drop through the month of July, only to return typically in the seasonality index of the S&P 500 back in the early fall. So we don't use this as a predictor. It just helps us explain things as they happen sometimes. All right. Once again, text your questions to 254-282-0495. And I want to talk more about the overall broader economic look of the economy now. So the Fed met in May. They warned of rising economic risks, and it decided to leave the overnight Fed funds rate where it was. Now, President Trump has been putting pressure on Fed Chairman Jerome Powell, but the Fed is not a political body. They are a non-government organization that controls the central bank, and they're not usually going to respond to political pressure. I think it's important to note here there's a lot of moving variables here, and the Fed has made the decision to keep those interest rates where they are for now. They don't want to send the wrong signal and have the economy overheat and we see high inflation again. And that's one of the things with tariffs going on. These are all factors that the Fed's waiting and seeing to see what's going on. Now, I noticed this morning that the European Central Bank cut rates for now the 8th time in a row. So they've been aggressively cutting rates for some time. but the Fed has stayed put. And so after a few small cuts in 2024, they've held the line and they're not doing it now. Their next meeting, I believe, is here in June, and then we won't have another Fed meeting until September. The rationale that the Fed has given in his last press conference in May is that there's really no cost to waiting. Well, the Fed is always looking at data in the past, and a lot of times things move faster than that. And inflation is still higher than the Fed wants, and we'll get into the inflation data, which I see some positive signs there. But to them, there's too much uncertainty. It's going to be really telling when they meet here in June to see what it is that they're concerned about. All right, so I've got two charts up here on the screen. One is from the U.S. Treasury yield curve from back from end of April, and one the end of May. Now, what the noticeable shift here is, at least for me, is that short-term rates have been falling a little bit. So this is going to affect your CD rates and things like that. Your long-term rates, things that affect things like mortgages, have been rising a little bit. At one point here early in the month of June, the 30-year Treasury was up above 5%. So a lot of movement there. They're going up and down all the time. What we're seeing now, though, is that the yield curve, and I've talked about this many times before, the yield curve is pretty much to a point where it has uninverted from its inverted shape that we had so long ago, where short-term yields were higher than long-term yields. And obviously that signals a recession, but that has changed. And we're seeing that to look to be more traditional, although not typical right now. Okay, so I threw this in because I wanted to show you the 12-month percentage change of the consumer price index. Inflation grew less than economists expected in the month of April. Won't be getting the May data here for a couple of weeks. But if you back out all the food and energy costs that tend to be a little bit more volatile, the inflation grew at a monthly rate of 0.2%, or about 2.8% per year. That's falling a little bit, and that's good news. And prices are still in check. Now, the things that are kind of unknown here is what are the long-term effects of tariffs? And you'll see that probably in some of the economic reports that are going to come out this week and next. You'll begin to see some of those things. One of the areas where it affected the gross domestic product, or GDP, the Q1 GDP growth was actually negative. Now, that might sound concerning, and it can be if it repeats itself over and over again. But we have to remember that when we look at the core GDP, consumer spending, business investment, home building, it actually rose at a pretty healthy rate of 2.5% annualized. So the big factor that's causing the negative GDP rate was the dramatic increase in the first quarter of imports. People were concerned about potential tariffs, and so we started importing. Manufacturers and suppliers in the U.S. started importing like crazy in the first quarter. That has all backed off now. And we saw in the first quarter, we saw the trade difference, the exports versus imports, to expand dramatically. That now has come back to more normal terms. So we're going to probably see positive results for the second quarter GDP. But remember, we're not in a recession until the government announces, or the BLS announces, that we've had 2 consecutive quarters of economic decline. And we actually had that during the COVID time in 2020 and 2021. And the government said, oh, no, there's nothing to see here. But we'll see what happens on this quarter. One of the things that's real positive, we use data from the Atlanta Fed, their GDP Now data. And that, as of a couple of days ago, was showing that they're forecasting quarter 2 growth at an annualized rate of 3.8%. And that's really good. 4% is what we like to see, but 3.8% annualized is a lot higher than it's been the last several years. Okay. And we see inflation cooling. One of the things that we look at is the preferred inflation gauge, the PCE indicator, rose just 0.1% in April and is only up 2.1% over the last year. These are signs that inflation is returning closer to that target of 2%. So the good news is the economy is not in a recession, but it's not booming either. It's stabilizing. So we like to see those things. And inflation isn't gone for good, but it's under better control now. So don't let the headlines, because everybody's going to attack everybody, and you'll see a lot of headlines in the news saying that Trump's running this or ruining that, the economy's in the dumps, and a lot of it is just not true on both sides. So if you find the middle is probably where things really are. But one of the things, and I don't think I've got a chart in here for money supply, but money supply, this is the M2. Sorry to bring back nightmares from your high school economics class. But the M2 is the amount of money that's in the economy. And this is something that we measure because as it increases, like it did during the COVID era, increases dramatically because we pumped $11 trillion into the economy through rebates and things of that nature. You saw inflation rise. We're still seeing that M2 going up again, but we're not seeing the corresponding inflation indicators. So something that's really important to watch, and we'll continue to watch that as well. All right, April employment report. We're still adding employers, 177,000 employees, 177,000 jobs added in the month of April. Healthcare and education led that with 70,000 new jobs. Manufacturing dipped slightly, down 1,000 despite a year-to-date growth in the sector. Wages are still rising, but at a much more manageable pace. One thing we worry about too much is wages going up too fast. People have more money to spend. That causes inflation. And so that's important to note. Unemployment was 4.2% in the month of April. And so the job market's holding up well. Wage growth is still just slightly above the Fed's comfort zone, and suggesting that the Fed might continue to delay cuts. But most forecasters are saying that the Fed's still going to have 2 interest rate cuts this year. And I don't see those coming in until at least the September or December meeting dates and so forth. Okay. Now, jobs reports will actually come out tomorrow. Sorry, but the scheduling of our webinar here doesn't correspond very well with the jobs report. You'll see that in the news tomorrow, Friday. That's June the 7th. And so there's an early a report from ADP, which is the HR payroll company, that hiring slowed down a lot in the month of May. We'll see. Oftentimes those indicators are quite different from each other. Okay. So let's talk. We talked about the trade deficit and stuff. What you're seeing here, that trade deficit hit an all-time high in March. I still haven't gotten the April numbers yet, but imports jumped nearly 18 billion in 1 month, and that's people trying to front run when the tariffs finally took effect to try to save money. And this import surge really hurt the economy a little bit, cutting the GDP about 5 percentage points off of that GDP indicator. And that's the reason we saw the GDP drop barely during that. And also, we're seeing signs that the trade picture is improving. Container shipments from China to the U.S. dropped more than 40% year over year in April, and that's signaling a slowdown in those imports. All that global trade dynamics they're shifting. They're shifting, and China is no longer the U.S.'s top importer partner. Mexico and Canada have taken the lead. And one positive takeaway from these is that the U.S. remains a net exporter of petroleum for the 34th straight month, a sign of growing energy independence. All right. A lot of people talk about manufacturing, and will bringing manufacturers back home really take advantage of things. here's a chart of how the U.S. compares in terms of value add for manufacturing countries. China obviously is number one. USA is number two. Now, we have seen manufacturing decline and jobs decline. The blue line on here is that decline over the last 60 or so years, 70 years. And you see the production, though, the value of production and productivity has been increasing. So even though payrolls, employees of manufacturing companies have been dropping over the last half decade, you're seeing productivity improve. So the U.S. is producing more and more high value, high quality products and using less people to do it. So we're just more productive. This one illustrates this as well. If you look at the U.S. in terms of quality over quantity, this is the manufacturing output per worker. All right, this is real impressive. We're number one. USA is number one, South Korea number two, and China is way down the list. And you can see the difference between those two countries. We're producing more high value materials, whereas other countries, not so much. Yeah, the producer price index declined 0.5% in April, as we said. That's good. We're just seeing those those costs and inputs. But the big driver here is services. Services also fell. That can signal a little bit of a broader softening in the economy. Even with core prices excluding food and energy drop, which is a positive sign for inflation, but they're still up 3% year over year. And we see some other indicators that say the economy could be softening a little bit, but we're still holding our own. All right. We talked about inflation cooling already. Let's see here. Housing remains the key driver of inflation. And you can see these changes in the CPIU, which is owner's equivalent rent. It's something that we'll keep an eye on. Consumers are making their paychecks stretch. They're not slowing down their spending necessarily. But the bottom line here is inflation is easing across most categories, even with the tariffs in play. And that gives the Federal Reserve more flexibility to consider those rate cuts in the months ahead. I hope that we will have some rate cuts because I think that'll do a lot for the stock market. Now, a couple of weeks ago, we had some bad news for the U.S. Treasury. The Moody's, which is one of the three firms that rate debt around the world, Moody's downgraded the U.S. debt to, gosh, I think it was just AA instead of AAA or maybe A minus. I can't remember exactly. There's a rating scale from junk all the way to AAA. But the markets really didn't panic. In fact, interest rates barely moved. Now, the Moody's is the last of the big three bond rating companies to move their rating down. If you go back to 2011, S&P, Standard & Poor's downgraded U.S. debt back then. That was during the Obama administration. Fitch downgraded U.S. debt in 2023. And then Moody's did this last month. The downgrade reflects really a long-term concern, not a short-term crisis. The U.S. debt load is growing. I think we've got $36 trillion in long-term debt with the federal debt that's growing every day. This is something that we want to make sure that we're keeping an eye on. As Trump calls it, the big beautiful bill doesn't really do anything to address spending. Even with the Doge cuts in different places, that will take some time to work itself out. So we're just increasing spending. We're not keeping track of it. So it doesn't matter what party you're a part of. Everybody likes to spend our money. And so that's really important during this. Now, I've got a question here that came in from a listener I want to answer in just a moment. But the downgrade got headlines, but the markets remain calm during that time. Long-term debt management still depends on spending discipline, which we don't seem to have in the U.S. government, and economic growth. We can grow our way out of the debt like we did during the 80s and early 90s. But what's happening here is that no one has a regard to really look at spending by the federal government. No one wants to cut their pet project. And of course, there's all sorts of stuff going around saying Medicaid is going to be cut. We're going to be killing hundreds of thousands of people. We all know that that's not really realistic, and that's not what's happening. I think what's happening is we're trying to eliminate some of the waste and the fraud that might be in some of these government systems. And believe me, there is plenty. So, not too worried about the U.S. debt being downgraded, rating being downgraded, but we have to keep an eye on that because we can get to a point where we're a country like Greece that had debt to GDP ratios above 150%. That's not good. All right, home sales stayed sluggish in April, falling slightly, still well below those pre-COVID norms, if you will. Sales patterns kind of vary by region, with most of the gains in the Midwest, but declines in the West and the Northeast. The median home price rose to $414,000, showing that despite fewer sales, prices are still holding firm. And with interest rates elevated relative to they were in 2020, mortgage rates are back near 7%. And that affordability is still a challenge for a lot of home buyers. Higher end homes are selling better, suggesting that the wealthier buyers are adapting to the new rate environment faster. But it's not 2008. Even though sales are slow, prices are stable, and builders are helping keep supply moving. What's really holding back that is high mortgage rates, low supply still, and those folks that have a mortgage rate locked in. I've got a 30-year mortgage at, I don't even remember what it is. It's below 3, maybe 2.5%. I don't want to buy a new mortgage that's at 7%. I want to stay in my house and keep the money myself. So inventory is picking up. That's good. And like I said, that high end home activity sales are doing this as well. And new home sales, same story a little bit. They kind of flattened a little bit. They've gained in April. That was the biggest monthly gain in almost 2 years. When 743,000 new homes were sold, that's an annualized rate. And this is now above the pre-COVID levels. Most of the regions saw growth. The biggest was in the Midwest. And we're starting to see those new home construction prices kind of moderate. And that's always good news. So, what does this all mean? We had a question come in from a listener about how small businesses are reacting to these things. Well, it is a challenge for small business owners not knowing, especially if they're manufacturing, not knowing what the cost of their goods will be going forward. I think a lot of small businesses are reconfiguring their supply chains to purchase more in the U.S. as a hedge, but we're still seeing borrowing costs to be pretty high. If you're a small business, it's hard to find a bridge loan for expanding your business and things like that for less than 10%. That's a lot more expensive than it was 5 years ago. So there are a lot of things that are going on here, but I'm starting to see housing prices kind of level off. The builders are offering a few more incentives. Hopefully, borrowing costs will not go up anymore. We're still waiting on that drop. But the big thing that I'm watching right now is in Washington. And what's the stability in Washington? Are we going to have a continuation of the Tax Cuts and Jobs Act rates from 2019? Just having that settled will provide a lot of positive influence for small business owners. There is a number of additional items in that bill, continuing the accelerated depreciation factor for small business owners. That's something that'd be valuable for people to invest. And so a lot of things that are positive there I see with that, but it hasn't passed, and we've still got to get to a point of getting that passed. So what's the solution, folks? You want to make sure the reason that that we do these is to try to help people understand what's going on in the economy. I hope that you are actively watching your investments. If you don't understand what's going on with those investments, talk to your advisor. If your advisor kind of blows you off, whatever, we'll be happy to talk to you as well. And we'll give you that overlook and overview of what's going on with your particular portfolio. Just don't be passive about understanding what's going on in your portfolio. Number one, don't panic. Markets are recovering from March and April declines. Don't make decisions. And we still have people calling in that are making decisions based on headlines. I know I've shared this once before, but the people that write headlines and for the big newspapers are not the people that wrote the article. And so a lot of times it's a kind of a fun exercise. I'll read the headline. If it sounds kind of interesting, I'll read the article. And oftentimes the content in the article doesn't even make sense for what the headline says. So don't make decisions based on headlines. Make sure that you're doing things in a very strategic way. The companies that are profitable, the companies that have good earnings, those companies are growing. Those companies are still providing value to their shareholders in the stock market. So just be careful about that, and certainly try to avoid the political bias. And we've heard it all. Left, right, doesn't matter, center, we've heard it all. And it's something that is just noise. We're more involved in focusing on what is the true policy coming out of Washington, what is going on with the Federal Reserve, how's the international economy going to respond to these things. Those are the things that are important. And ultimately, the value and the returns that those individual companies will have, okay? So remain calm, as they said in one of those late 70s Moody's Animal House. You've got a 401k, take a look at it. No one is managing your 401k except you. And how's that done? If you're have a target date fund or a life cycle fund in that portfolio, you're probably not doing as well as the S&P, which is to be expected because bonds are down so much over the last 5 years. But that doesn't mean you should make any rash changes. We can talk to you. We have a service that we can provide to you that helps you allocate, rebalance, and things, your 401k, even though you may not have someone helping you. Check your statements, folks. May is going to be a good month. Hopefully June will as well. But talk to a professional. If you are not working with a financial advisor or a tax professional, or really all those people should be talking to one another about your portfolio, come see us. We'll give you some insight and try to educate you a little bit. So, questions coming in on the board. I did see one. I think we've addressed it. So with that, I just want to remind people that you can always contact us at info@clearvistafinancial.com, info@clearvistafinancial.com. And you can always call us at the office, 800-491-4508. And with that, folks, I don't see any more questions on the board. We will call it a day, and we'll talk to you next month. July 3rd is that date. We will be doing a program that particular date, and then we'll take some time off after that. But thanks for listening to the ClearVista Financial Perspectives Market Update for June of 2025. Thanks.
Securities offered through Cambridge Investment Research Incorporated, a broker-dealer, member FINRA, SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and ClearVista Financial are not affiliated. Discussions in the show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions.